What's up, guys? Wes Hankins here, president of Vault Financial. So the purpose of the video today is to talk about home equity lines of credit. All right. So we all hear it a lot. We kind of hear the term HELOC quite often, but it's kind of my objective to simplify this so you guys have a basis of understanding the good, the bad, and the ugly of the HELOC. Right. So HELOC, home equity line of credit. That's what it stands for, right? So what does that mean, line of credit? What does that stand for? How does that work? Here's the most simple way to understand it. It works like a credit card. So if you get approved and you close and you open up a line of credit for $100,000 on your home, you do not pay any interest unless you borrow against that line of credit. So just like your American Express or your Visa or whatever, you do not pay any interest if you're not borrowing against it. And this is the key component. So keep that in mind. This is what I like about it. So you go through the process, you open up a home equity line of credit. Maybe you borrow $20,000. Okay, so you borrow $20,000. You need to put in the pool or backyard or whatever you need to do. $20,000, and you will only pay interest on that $20,000, leaving you $80,000 accessible to you if you need it again, right? So how does that differ than a quote unquote normal refinance, or quite often what we hear like a HELOC loan, right? If I give you a mortgage for $100,000 and it's not a line of credit, you're going to get $100,000 and you're going to pay interest on the full $100,000 right away, right? So quite often we use home equity lines. I mean, there's a million reasons, but home equity lines quite often are used for future projects or for just in case. Often they're used for maybe temporary money, right? So let me give you my example on where I have home equity lines of credit. So I have multiple properties, okay? And I have home equity lines of credit on all of them. So quite often we'll flip a property, right? I'm not an active investor where I flip homes on the daily, but being in the industry, we do come across deals, and quite often those deals, you have to make a decision right now, right? So get the phone call. Hey, Wes, my grandma died. The property's got a tenant in there. They destroyed it. You know, we walk them through the counseling, get them to talk to a probate attorney, have them talk to realtors, whatever. They decide, hey, we just want to offload this thing. We just want to be done with it, right? Well, I have home equity lines of credit that I can say, all right, Bob, whoever it is, I'll give you a cash offer for this amount and I can close immediately. So I've literally had examples in my life where I've gone to the bank and I say, hey, bank, I need a cashier's check for $100,000 out of my brokerage account. I have to meet with the president of whoever it is, and it goes through a long process of me being able to access my own money. Sometimes it takes 24 or 48, a couple of days to actually do this, right? Where I walk into the bank and I go to my line of credit and I say, hey, I need $100,000 off my line of credit. It's immediate. It's right there. I mean, I wish I could explain to you why it works that way, but it's just easier to access. So my point is, the home equity line of credit really allows you guys, in my opinion, is the easiest line of credit for business owners, for regular homeowners, for people to access their money relatively easily. Now, going back to the example of what I do, right? So I go buy the property, fix it up, sell it, pay back that line of credit. This is where it's key. So now I borrow the money, I pay the line of credit back down to zero. So now I'm not paying any interest anymore, okay? But I still have the line of credit available to me. So that process, you're allowed to pay it down, put it back, all that kind of stuff. You can usually do that between 5 to 10 years. So the way that it works is you open up the line of credit, you have 5 to 10 years that you can borrow against it, pay it back down, borrow against it, pay it back down. So when using it for temporary money, I like it for that, because it's just like, hey, I just need this for 90 days, and you basically need for 60 days, whatever it is. I've even coached some clients to purchase vehicles with it, right? So maybe you want to go buy private party, you want to go and buy a vehicle cash. You're now a cash buyer. You're not getting an auto loan. Maybe you go buy that car, private party. That's a good deal because you now negotiated it lower for $30,000, $40,000, substantial amount, not $5,000. And once the dust settles, you get the pink slip, all of that kind of stuff. You can then actually go refinance that vehicle with your credit union or whoever it is and pay back your home equity line of credit. These are just examples of many things that you can do with the home equity line of credit. Now, Let's talk about what is a more common thing that we get. Wes, I want to put in a pool. Okay, you want to put in a pool. Normally, in my entire career, we would look at refinancing their entire mortgage. The reason being is that a pool is one lump sum. The pool is going to cost $100,000, right? So they need the $100,000. Well, what's happening, as you can imagine, right now, everyone has really low interest rates on their first mortgage. So we're not going to kill a 2.75 at 400 grand to borrow $100,000, let's just say it's 7.5% interest rate, right? Random rate. We're not going to do that. So we're going to give them, we're not going to refinance all into one loan. We're going to look at doing a second mortgage, the HELOC, right? So the reason why the HELOC is good in these examples as well is because, hey, Wes, I need $100,000 to put in a pool. Okay, let's go over your options. Let's go over them. We're not going to do the first. We've gone over that already. But we're going to go ahead and do a second mortgage of some kind. It's going to be a fixed rate second, which is often called a HELOC, or it's going to be a home equity line of credit. So the good, the bads, and uglies of doing it that way. You open up the line of credit, right? Again, $100,000, zero balance. You can then pay as you put in the pool, right? Here you go. And now at the end of the term, you have a $100,000 balance on a $100,000 limit. Your HELOC is maxed out, right? So you have two payments. You have your first mortgage and you have your HELOC payment, right? Here's a cool thing about the HELOC. Your pool's in, everything's good. Maybe you get a bonus check, right? Maybe you get a tax refund, a substantial amount of money. You can then tackle that second payment, that HELOC payment by itself. You can dump all your money towards that HELOC. And here's how this works. Let's just say you take $5,000, you pay it down. So now you don't owe 100, you owe 95, right? Now you do that a couple times, boom, boom, boom. Now you're paying down that HELOC. You're rapidly doing it, just dumping all the money towards your HELOC. Now you're down to 80,000 bucks, but the transmission goes out in the car. The home equity line gives you a checkbook. It gives you a debit card. You can then use that money, bring the balance back up to $90,000, right? I think this is a huge tool if people understand how this works. Because let's think about it in the terms of a fixed rate loan. Hypothetically, I give you a fixed rate, fixed term. Let's just use the term 30-year fixed. Second, here's $100,000, and you take that same $5,000, $10,000, and you dump it towards the principal of that mortgage. You can't get it back. It's stuck in there, right? The only way to get that 10 grand back is to do another refinance or sell a property, right? All it does is it pays the loan off sooner. But the line of credit, you essentially can put all your money towards that, pay it off, pay it down as quick as possible so that you're not paying interest on there. And that way, if you do get into a bind, you do need to pull the money out, you can just write yourself a check and have that money back in your hands. So with that being said, I don't want the home equity line to act as your cash reserves. A lot of people do this and they think, oh, I don't need to have savings. I don't need to have reserves. I don't need to have things like this because I have a HELOC. That's not true. I would not say that. This is why we're here to kind of coach you through here. And everybody has their own anecdotal experiences when it comes to the home equity line, right? So let's talk about this a little bit further. The draw period, 5 to 10 years. After that time, let's just say you have a $100,000 balance on that line of credit. After 10 years, what happens? It's not a balloon. It doesn't explode. What happens is you have 5 to 10 years to use it as a draw period. After that time, it turns into a 20-year loan. So during the 5 to 10 years, quite often you usually have multiple payment options. I usually tell people just pick the interest-only option, meaning you only have to monthly pay the interest. But again, it's like a credit card, right? This is your minimum payment. You can dump tons of money towards it. You don't have to follow a payment schedule. You can put money towards that home equity line, pay it down, do that for 10 years. So for the 10 years, you have an interest-only option. After 10 years, it turns into a 20-year fully amortized note. So the thought process is this is a 30-year loan. For the first 10 years, you can use it like a revolving line of credit. After 10 years, it turns into a 20-year loan fully amortized. What that means is at the end of the 30, 10 plus 20 is 30, you'll have a zero balance, right? So what usually happens is people in good standing, I usually tell them, hey, On year 10, we'll just give you a new home equity line of credit. That's not a big deal, right? So let's talk about qualifying for home equity line of credit. Home equity lines of credit are traditionally second mortgages. All second mortgages are harder to qualify than first deeds of trust. The reason being is that in a foreclosure scenario, if you go default, whatever, the banks have to foreclose. And the reason why we say first and second is because that's the order they fall in priority, right? So these mortgages are going to be falling in second position, meaning that if the house value goes down, the first mortgage gets paid, then they get paid. So you quite often have to have higher FICO scores, a decent amount of equity, meaning they're not going to allow you to borrow all of your home equity. Quite often, many credit unions are capped at about 65 to 70% of your home equity. Most of the time it's 80%. I even have some products that will go to 90%. But again, they're harder to qualify, all of these things, okay? So the typical closing costs on home equity line of credit, they tend to be cheaper than a first deed of trust because they tend to be smaller. They're just smaller amounts. Usually they have minimum amounts of $20,000 to $50,000 depending on the banking product. Now, where do home equity lines come from? 99% of our business in the mortgage industry is done by what we call agency. Fannie, Freddie, FHA, VA. We're all familiar with those terms. We can talk about that in a different video. Home equity lines of credit are not backed by any kind of agency. They are actually the bank's money. What that means is if you go to Vault Financial and you want a full refinance, I'm probably going to offer you a regular Fannie Mae loan. If you go to Wells Fargo, they're most likely not going to be giving you Wells Fargo's loan. It's going to be backed by Fannie Mae. We're essentially selling you the same product. But home equity lines, and for the most part, all second mortgages are going to be, but Wells Fargo for this example, it's going to be Wells Fargo's actual money. So what that means is all of these banks, this and this credit union, Wells Fargo, Bank of America, they all have little nuanced things that they will and will not do. So though they kind of work on a broad scale, they all work the same, there are small nuanced things. For example, the drop period. Sometimes I mention 5 years, sometimes I mention 10 years. That's something that's happened in the last couple of years where they've all shortened them from 10 years to 5. I don't have an exact answer, but I know that in my world, as I'm shopping out different products and I'm learning from different banks, they all have different options. Another example is some home equity lines allow you to fix in portions of it. So let's go back to our $100,000 line of credit. You might open up for $100,000. Maybe something happens economically where the feds drop their interest rates pretty far down and you want to lock in a certain balance. You pull $50,000 on it, you want to lock it in at that 6%. Some banks allow that. They charge you a fee, but they allow you to lock it in. That way, if rates tend to go up, you're not subject to that, right? So as you can imagine, there's a lot of things to learn, to talk about these home equity lines of credit. I just gave you a lot of information in a short amount of time. Me and my team are here to help navigate this, help you figure out what is the best for you and your needs. So reach out to us and looking forward to working with you.